Time for another Q&A from Sunday's Market Outlook. First, though, I'm going to just bring you up to speed on the additions to the Applied series. Let's start with Applied Analysis. You click on My Videos, scroll down to Applied Analysis, you'll see 4 folders. Click on Infographics. We've added quite a few here. We're going sector by sector. We're on consumer staples right now. All the sectors will be added, and there'll be an infographic for each sector, each industry group or industry, because sometimes the industry group and the industry are the same. One for every sub-industry, and then one for companies within the sub-industry. They add up to 100 points. 10 at the sector level, 20 at the industry level, 30 at the sub-industry, and 40 at the company level. And they're meant to get you up to speed very quickly on a particular company. A company is embedded within a sub-industry is embedded within an industry is embedded within an industry group, and an industry group is embedded within a sector. So if you know 10 things about the sector, you know 10 things about every company within that sector. And then we can select an industry group. Again, we're just adding these. I started with the 30-20, beverage, food, and tobacco. Tells you to select an industry. We've added beverages. We've pretty much filled out all of beverages. It'll give you 20 critical things you need to know about the beverages industry group. And if you scroll down through these, you select a sub-industry, and these are the 3 sub-industries within that industry. You have brewers, you have distillers and vintners. This is your hard liquor and wine. And then you have soft drinks and non-alcoholic beverages. So if we click on distillers and vintners, here are 30 points you should know about that particular sub-industry that are true for every company in this sub-industry. So by the time you get to this 30, you have done 10 at the sector level that apply to every company in this sub-industry. You've done 20 at the industry level, 30 at the sub-industry level, and then you're ready to select your company. So we have Constellation, Diageo, and Brown-Forman. So if we click on Diageo, we should get an infographic for critical top 40. I've tried to put them into groups. So as you go to each company, you'll see that there are some points about the corporate structure, a discussion, especially if it's consumer products, a discussion of the brands and the portfolio that they have. We can see here, unrivaled Scotch whiskey portfolio. Diageo is the undisputed global leader in Scotch whiskey. Portfolio includes the world's #1 selling Scotch, Johnnie Walker, and a vast collection of iconic single malts. Dominance in U.S. tequila. Company has a powerhouse position, high-growth tequila categories, owning both the original luxury brand Don Julio and the celebrity-founded ultra-premium sensation Casamigos. Other things that it owns, global giants, leaders in their respective categories, Smirnoff, Tanqueray Gin, Captain Morgan, Bailey's. So it really gets you up to speed. We have a whole section of consumer goods. There'll be a section on what are the brands that it owns. This one, they own Guinness as well. Some financial characteristics that you should know about the company. For example, if we look at Keurig Dr. Pepper in the soft drinks, the thing that jumps out right away is the sheer amount of debt that they have. So that'll be in the financial characteristics. Operations and supply chain. For beverages, this is important. Some operate their own supply chain, some partner. For example, Celsius and Monster partner with Pepsi and Coke, respectively. Keurig Dr. Pepper distributes for a whole bunch of other brands, not just its own, because it has a big distribution fleet. That's important to know as well. Financial characteristics with the capital allocation. This is focusing on the type of debt and equity structures they have. Some things that are important for their future, what their plans are, forward-looking statements. There should be a section on risks. Some of them have important risks. It depends on the company, right? So there's Diageo. You click down, we can get one for Constellation Brands, and you get one for Brown-Forman. And I think this is the most important point, corporate structure. A family-controlled enterprise, most crucial fact to know. Brown family has controlled the company for over 150 years. They hold the majority of voting Class A shares, giving them effective control over the company's strategic direction. Here's where we talk about their portfolio. Jack Daniels is the crown jewel, and there's a lot here in that discusses what it is that they sell. If we scroll back up here to the sub-industry, we can then go to soft drinks and non-alcoholic beverages. These are 30 things you should know about that sub-industry that apply to every company. And then we have Coca-Cola, Pepsi. These are the big ones, along with Keurig, Dr. Pepper. And then you have more specialty ones, Celsius and Monster in the energy sector. Monster distributed by Coca-Cola. So if we click on, well, let's just say Coca-Cola, we should get a listing up, business model and relationship, corporate structure and governance, operations and logistics, financial profile and strategy, product portfolio, third-party agreements. So everything that I think that is important to know, 40 points. And so we're going to fill out all the sectors. Every company, hopefully, depending on the structure, every company that you get to, you'll have gotten to through 100 points. 10 at the sector, 20 at the industry, group or industry, 30 at the sub-industry, and 40 at the company. So there is the infographics. From there, we can head over to the question bank. And under applied level, we have 519 questions in so far. Click on applied analysis and you'll see we have questions in sector studies and in financial modeling. We'll expand sector studies. We have a lot of content. Unfortunately, we're limited now by the speed with which we can get it into the system. So we have infographics for consumer discretionary for some companies in there, especially in the home builders and the auto manufacturers. For those of you who have the applied level, the sector studies, you know that I've done sub-industry videos on those. So we had those, a lot of notes for it done. Utilities and materials. So we have a bunch of questions in each one. And for financial modeling, we're going to break it down by sector, and within each sector there'll be a plus sign here. All the sub-industries. Same with here, all the sub-industries. So once you get to know a company, you can go to the Sector Studies QBank and you can find questions pertaining to either that sub-industry or that particular company using actual data. And I'll show you a couple of the questions shortly. For financial modeling, the questions here are built as mini case studies. They're not questions. These will take you anywhere from half an hour to 45 minutes to solve. They present a mini case study and they ask you how you would model a particular line item. For financial modeling, what I had in mind was, rather than showing you how to model a whole company, I was going to go find companies that had very complex debt structures, very complex derivatives in place to hedge something, and model that. The problem I was having was finding a company that had that stuff. You go from company to company to company, and you got to spend time with it. You go to the section, you start reading, you start thinking, how would you model this? You go, no, this is not what I'm looking for. This is too easy, or this isn't quite right, or this doesn't. I couldn't find what I was looking for, so I thought, well, why don't I just create a scenario? And that's what these are, mini case studies with scenarios, but they are not easy. Let's just take a walk through some of the questions and let's see what we have. So this is a typical question in the beverages category. I've denoted them with skull and crossbones. If there's no skull and crossbones, it's a medium question. It really is not so much, and none of these questions really are here to test you. They're here to teach you. All of these are formative assessment. If it has one skull and crossbones, it's a hard question. If it has two, it's a brutal question. The goal is not to get it right. The goal is to learn. So if you remember your undergrad, we learned more when we learned by case study than when we learned by textbook, and that's what I'm trying to do in these. You cannot answer these with lower levels of cognitive skill. You're not going to memorize your way through this. Even if you understand everything, it's not going to help you. There's no procedure here. It's not like you have to calculate something and come up with an answer. You have to analyze, get the important facts out, and then you have to evaluate. That's metacognitive skill, something the LLM probably is not going to be able to do for some time. So let's just give you an example of the type of question setup. Here is a good example of one. Multinational Spirits reports their 12-year aged whiskey portfolio generates 42% gross margins but turns inventory 0.3 annually, while the recently launched ready-to-drink cocktail line achieves 28% margins with 8.5 times inventory turns. CFO proposes shifting production capacity from aged spirits to ready-to-drink, citing superior cash flow generation. Meanwhile, luxury goods conglomerates have acquired 3 competing whiskey brands at 25 to 30 times EBITDA multiples in the past year, which strategic assessment best evaluates the CFO's proposal given these market dynamics. You're not memorizing your way through this. You would have to understand something about aged whiskey. You can't just produce it. It takes 12 years to get 12-year whiskey. You can't just produce it, but generates 42% margins. Look at the premium the market's placing on this product, 25 to 30 times EBITDA. And you have this stuff here, which is really easy to do, 28% margins, which is low, turns over a lot. Which one is going to get crowded faster, right? You have to be able to evaluate. So you have 3 options. And then in the answer, I tried to load in a lot of learning about the particular industry or the particular company. And some sort of takeaway, strategic insight here in spirits: time creates value that efficiency cannot match. Again, it takes 12 years to make a 12-year whiskey, right? And it has, the longer you wait, it increases in value, and it's not linear. An 18-year-old whiskey is not 1.5 times more expensive than a 12-year. It's almost 3 times more expensive. So the longer you wait, the price doesn't go up linearly, it goes up exponentially. And because it's rare, because it takes that much time, for a good brand, it trades at incredible multiples, right? And why these are incorrect. And again, trying to give you some sort of takeaway. And again here, why B is incorrect. Sometimes it's a different type of setup. Here's question, let's see, let's scroll down here. Let's see if we can find something for a particular company. Let's see if this is on a particular company. So these are all for Monster Beverages. And we give you some consumer staples premise, something that is true at the level of the sector, and something that is true at the level of the company, and then asking a question. Since the company is embedded in the sector, the truth of the sector will infiltrate the company. This company is not going to operate so far out of the rules of the sector. It will. The reason it's in this sector is because it shares the characteristics of that particular sector, so it's going to be influenced by it. And then you just have to answer a question. What else have we got down here? I think we have other, same with, we're still on Monster. Keurig Dr. Pepper. So I give you a scenario of something that has happened and a question. Despite the likely decrease in reported regional revenue, this strategic move is best evaluated as an effort too. So here's what they did. And it asks you a question about the scenario and ABC. The first step, you have to analyze, you have to pull out the proper information. Step number 2, you have to evaluate. I break it down like that so that you can get into the habit of understanding what analysis involves and what evaluation involves. If you see these questions enough, you go, oh, I understand the difference between the two. So analysis is you look at the landscape and there's lots of information. It's a matter of picking out just the right information. That's the analysis part. Looking at the scenario and saying, look, this other stuff is irrelevant. This is important, this is important, this is important. You pull that out. And evaluation is say, from this information that I pulled out, the relevant stuff, what am I going to do? What strategy should I follow? So I try to get you in the habit of thinking that way. And then why A is incorrect, why C is incorrect. And you'll learn a lot about Keurig by going through these questions, and a lot about the business model and the trade-off in decisions that are made in this. Let me see if I can find some questions for financial modeling. Yeah, let me drag this across here. We'll stick this here. So here's a good setup for a type of question for financial modeling. And again, the reason I'm doing this is you almost have to come across the scenario that you're looking for. And so you might be looking at a REIT and you might say, you know what this would be good for is this. But if you say, you know what I'm looking for is this, try to find it. You go from company to company, an hour and a half later, you still haven't found the scenario you want. It's a huge waste of time. So I just designed scenarios. Skyline Residential REIT prepares financial statements under IFRS. 20% of its portfolio sits on long-term ground lease parcels, fixed annual escalations. IFRS 16, the leases are recorded at 140 million lease liability, discount rate 2.5, matching right of use asset. And then you have some things for 2025, cash ground rent paid, IFRS reported interest, lease liability. This is all stuff you get if you go to the financial statements, you go to the section on leases. This is all information that's given to you. The ROU depreciation 4.6. And it gives you a scenario, right? The ground rent steps up 3% per year. Management's revolving credit agreement sets a covenant. Net debt to adjusted EBITDA must remain below 9 times. Adjusted EBITDA per the credit agreement is defined as EBITDA before IFRS 16 lease accounting impacts. Treat ground rent the way it was under old IAS 17 as an operating expense. All of that is conventional. No balance sheet change are expected in 2026. And here is your task. You must forecast 2026 net debt to adjusted EBITDA for the covenant compliance model. That's no easy task with everything I've given you. You're not just going to solve that very quickly, but you don't have to come up with it yourself. I give you 3 options. Do you do it this way? Do you do it this way or this way? So you do have some room to work with them where you say, well, all I have to do is find a weakness in 2 of them. If you don't know which one is right, you should be able to spot the modeling or the accounting weakness in A, B, or C, and that gives you the correct answer. And I tried to explain it as best I could. Alignment with contractual metric, not just accounting standard, cash-based leverage insight, a 2-step modeling process, and sensitivity preserved, so that we know that when we build our model, we want to isolate variables in such a way where it allows us to do sensitivity rather easily. So this will show you how to handle that. Why A is incorrect, the pure IFRS trap. Why C is incorrect, half unwind, half comply. Another way I've done it, other than just this way, is more of a reading. So here's your setup, right? Residential REIT, 5,000 unit portfolio, 3 metro areas. Legislators are considering rent stabilization measures of varying structures. Annual increase caps, vacancy decontrol provisions, means testing requirement. Now this is all stuff that you got to know about the REIT space. You're looking at these words going, I don't know these. Well, you're not going to go to the financial modeling questions unless you've already learned about residential REITs, office REITs, all the REIT space, and you know all the language, you know all what these words mean. Current polling suggests 60% probability of passage within 18 months. REIT's portfolio has an average 8% annual rent growth, 15% resident turnover. Which modeling approach would best capture the financial impact of potential rent regulation scenarios on portfolio valuation operating strategy? You have 3 choices, and then it'll give you the answer. And then it gives you a mini tutorial. Look how long that answer is, right? 1, 2, 3, 4, 5 paragraphs. A is incorrect, and it gives you a mini tutorial of why that's incorrect, and same with C. I don't know which one you're going to like better, whether you like these quick bullet point answers of what it is, or if you want a more detailed description. So when you read one of these, you're going to walk away learning something very important about how to model that particular line item. For each sub-industry, I'm hoping to have anywhere from 30 to 50 questions. Once you get to about 30, you start running out of line items because there just aren't that many line items to model. So you start running out of line items. So you start thinking, well, maybe I'll think about, how this relates to the cash flow or how you would do this. Some you can keep going, but some like REITs, once you get to about 30 questions on REITs, you're kind of out of line items. So these are the additions to applied analysis. For applied asset management, where are we on applied asset management? Let's go up here. Let's go to back to my videos, and we'll just scroll down. I'm probably going to add some questions for the options, because I think there's a lot of great scenarios of which I can say this stock is doing this. Here's a chart of this stock. Here's the implied volatility. And here's your expectation. What's the most effective option strategy to follow? So I'm going to try to get some of that done, but again, you have to just sort of come across it. You have to just be doing it and say, oh, you know what? This stock here, right now would be good for this type of question. But if you think, I want 10 questions on this, yeah, good luck trying to find a stock that sets up well for a question you have in advance. So we have applied options, portfolio construction, positions. I update that every week. And screeners. We had a bit of an issue with the screeners. They were catching things a little bit late, and it wasn't really where I wanted it to be. So I thought, well, let's see what we can do with AI to get it done. So let's look at where we've gone there. I've been using Perplexity Labs, and I wanted it to develop a list, my momentum lists for 52, 26, and 13-week momentum. Not quite where I want it to be yet. It does give me some good output so far. I like these charts that I get out of it, which gives me stocks near the 52-week high. I can see by sector. So you see green, a lot of financial, so there must be something interesting going on there. Technology is always showing up there. Gives me a list of companies, but I don't like this list. So I got it to try again. Let me show you where I'm trying to get to. Is something like this, because then it gives me the notes at the same time, so I don't have to go looking for it. So what I'm hoping to get is the ticker. Exchange it gives me, I don't really think that's important. The sector, what the 26-week high was, and here I'm looking for, it had to set a 26 high more than at least 3 times in the last 5 days. It tells you the dates that it sets, where it is sitting from the highest point, and what it thinks or notes that it can find from the news feed. This is not quite perfect. It's making mistakes. So it's not there yet. For example, it's saying 13-week high. Verizon puts it at 58.92. Right away, I recognize that as wrong. But the notes are right. Raise fiscal year 25 EPS, wireless average revenue per user is up. That's correct, and it gives you a bunch of sources that you can then check it. So I am working on this. I've tried OpenAI. And I wanted to do a certain thing. I wanted to email me. I wanted to automatically execute at 6 a.m. every morning and email me the list. So ChatGPT, automatic scheduling, not possible. Push notifications, email, not without user initiation. Passive monitoring must be prompted manually. It can't do any of the things that I would like it to do. So I'm trying to develop it in Perplexity Labs. You have to have a subscription for Perplexity to get Labs. It's not working out well in Labs, and that's a problem because you have to reverse engineer the prompt because you can give it an instruction, but you don't really know what it it understands it to be. You can see the steps that it's going through, but you don't understand what it understands it to be. So you want to reverse engineer it. And how that works is you write your prompt and you give it to the model and you say, I do not want you to execute this prompt. I want you to tell me how you would execute this prompt. And then you give it the prompt in quotes. And it'll tell you how. And then from there you could say, I see. No, don't do this, don't do this. Yes, do that, but do this more, do this, do that. And then you keep iterating until how it tells you it's going to do it is the way you want it to do it. Then you say, what prompt would I have to give you such that you would end up with your current understanding of how you would execute the prompt, and it will give you the prompt that you can then give back to it that would give it the exact set of understanding it has. You have to reverse engineer it. Well, Perplexity Labs, every time you ask it a question, it says working 8 minutes. and it takes so long and it does so much work, and you think, okay, you're not getting to where I want to be. Anyways, I'm in Costa Rica, August and September. When I come back in August, I'm hoping that the momentum prompt is up and done and perfected. I'm getting closer. I just need a little bit more work on it, but that's coming. Okay, let's get to our Q&A. Okay, I haven't had a chance to read any of these yet, so I'll be seeing them as you're seeing them. Have you heard of a British economist, Gary Stevenson? No. He also has a rather interesting book I highly recommend, even if you disagree with his views. It's a great story. Yeah, I don't know him. Now that you're paying more attention to the Canadian market, I'm curious to hear your thoughts on the potential impact of the protective steel measures Carney announced on the week of the 13th, including in the context of potential retaliation from China. I didn't dive too deep into it. I know that he introduced a package which had up to I think almost $1 billion in support, which I kind of think he had to. But other than that, I really didn't dive into it. I'm not interested in the steel industry in Canada. For what I'm invested in, utilities, banks, and REITs in Canada, it's not a thing. And while I am sort of more attuned to the Canadian investments, I'm still not what you'd call anywhere near an expert on the Canadian economy. That would take at least 6 months to a year of really following the economy to get a real feel of it. It's just not something I want to do. I am sort of moving away from the US for a while, just until this, what do you call it, volatility? I think it's more than just volatility. It's one person, just until this sort of dies down a bit. Because this, to use a Squid Game analogy, this green light, red light, it's just a little tiring. You can't really take significant positions just in case he starts yelling red light again, right? Although the market is sort of beginning to ignore him. On Sunday's Market Outlook, I said that he really, really needs to get the focus of Epstein off him. I mean, he is lying about it. I mean, duh. But he needs to get the focus of Epstein off him. So look for him to say some crazy shit. So what's going on today? Wants to throw Obama in jail for treason. He'll start saying more of that crazy shit. And if the crazy shit won't work, he'll do crazy shit. How do you invest in an environment like that where it's, red light, green light? Regarding your discussion about PPI, it excludes imports. So wouldn't this simply not include any tariff effect? Well, an import doesn't stay an import. An import gets put into something else. The imports at the border. To say that PPI doesn't include imports, how would you know? So let's say that rubber is imported into the US and it gets put into a tire in Ohio, which then goes on a shelf in Walmart for a price that goes out. Are you saying, well, no, we can't include that because rubber was imported? I mean, it's in the value chain. All these imports find their way into the value chain. So while it may not include a specific thing, it does find its way into the value chain that is going to be impossible to tear out. So when you look at this tire at Walmart, how do you know what percentage of it to exclude? You know, I think that would be a hard thing to pull apart. Additionally, import prices, which exclude tariffs, have been mostly flat, which would indicate that American companies or consumers are paying for it. Unless you go category by category, that's going to be hard to say. These would be expected to go down as sellers were absorbing 30%. These are reported in US dollars. You have a decreasing US dollar, which means if you had the same quantity coming in, you should have decreasing imports if you have the same quantity. For it to be flat, it must mean quantity is going up. Now, you can look at real imports. You can go to international trade in goods and services, which is a report, and it on, I think, second or third page, it will give you the real imports and exports. Give it to you in real dollars as opposed to nominal dollars, and you can see whether quantity is going up or going down. See if sellers are absorbing 30%. It's 30%. I don't know if it's 30%. How do these things work in your view on the inflation outlook? So I think there's too much being made of this. Goods, as I showed in the market outlook, if you look at goods, including food and energy, against services, it's about 1/3 of the economy. Again, that's including food and energy. And the stuff that's being imported into the country, you can say, well, there's $4 trillion of imports a year. But 20% has a carve out, so it's like 3.2 trillion. But that's not 3.2 trillion, right? You import glass bottles. Next month you import glass bottles. You import glass bottles. So if you're doing inventory turns and you're importing your stuff, the price only happens once over here. So let's say that you were importing something for $2, and then with the 10% import tariff, it's $2.20. So you say, aha, inflation. Next month it's $2.20. Next month it's $2.20. Next month it's $2.20. Zero inflation, zero inflation, zero inflation, zero inflation. So if we think about 10 inventory turns a year, you're not importing $3.2 trillion worth of stuff. Inflation's really going to happen only on $320 billion when it goes up once and then stays the same price all the time, because it's the same thing coming in. It's not as if there'll be a tariff on top of a tariff on top of a tariff on top of a tariff. So $3.2 trillion worth of stuff aren't going to be inflationary. 1/10 of it, if we assume inventory turns of 10 times a year, 1/10 of it is going to be inflationary. Certainly not 100%. If you say, well, okay, it's 5 times a year, not 10, well, then only $640 billion will be inflationary on a $30 trillion economy. And assuming 10% tariff, and again, it'll only capture it once. It's not going to capture it every month. And if we assume that it's split 3 ways, the exporting country, the importer, and then the consumer, it's not $640 billion. Divide that by 3. You're going to come up with about what, $213 billion is going to be the net effect on a $30 trillion economy. Too much is being made of the inflationary impact of tariffs. Way too much is being made about it when you consider, in the end, how much actually will show up in prices. Oh, all the tariffs will show up in prices once. When you import the same thing next month, it'll be the same price as the month before, with the tariff, and then the next month will be the same price as the month before with the tariff, which means zero. Yes, it's 10% higher or 20% higher, but that only happens once, not every single time you import the same stuff. I think you get what I'm saying, right? I think too much is being made of it. Way too much is being made of it, and not enough is being made of the sheer impact that AI is going to have. That is going to be massively deflationary, because that is either going to be a huge productivity boost, which is going to raise supply lowers prices, or it's going to cut a lot of expenses out of the system. Let's look at what GM said, the hit because of tariffs. They still maintained their guidance for the year, and they said we can offset 30% of that. Right away, we can offset 30%. So there'll be some price increases going through. So what Besson said, the exporter will absorb a third, the importer will absorb a third, and the consumer. So GM is saying, yeah, we can absorb 30% through rationalization, cost cutting, this and that. We can absorb 30% of that. There's a third. Right? So yeah, there'll be some price increases once. Just once. Oh, let's keep going here. Pointing out the potential ceiling for stablecoins limited by the existing T-bill market capacity. Well, I don't know that I'd say it's limited by the existing T-bill capacity. These things have to be backed by T-bills or cash. So let's say that I'm the issuer of stablecoins and I'm getting more cash in, I'm giving out stablecoins. I want to invest that cash. That's where I'm going to make my money. I go into the T-bill market, there's nothing there. So I'm going to go into the reverse repo market. I'm going to say, okay, you have a 20-year bond, you want it financed, I'll finance it overnight for you. And that's a reverse repo. So that, the reverse repos satisfy as well. So you really have, based on the public float, a $30 trillion market. Not just a $5 trillion market limited by T-bills. Let's see. I would like to get your opinion on a potential counterforce that might encourage the U.S. to venture beyond this limit using geopolitical perspective. Kazan, BRICS nations formally proposed creating their own asset-backed digital currencies, claiming to be an alternative, even parallel system to existing payment systems. On strategy, do you think the U.S. recent rapid regulatory actions with the Genius Act is less of an economic policy but more a necessity, as it is an unavoidable move to counter BRICS de-dollarization threat? Well, you know, you could look at almost any action as either being an advantage or a necessity. And if your competitor is doing something, then it becomes a necessity. So AI, is that a competitive advantage for a company to adopt in its use? Maybe not. I'm not talking about building the models. I'm talking about using AI now. Is it an advantage or a necessity? If more and more countries are doing something, you almost have to do it just to be competitive. So yeah, you could argue that, well, you know, why can't it be both things at the same time? Why can't it be a competitive advantage move that also acts as, hey, we almost have to do this? Because you can say, look, let's do this. Let's be the first to do this. Everyone else is going to do it anyway, so we kind of have to do it. So you could say it is a competitive necessity well before it actually becomes a competitive necessity, because you can see that it will be. Sure, I can accept that. On valuation, is this indeed a strategic imperative? Does it fundamentally change how we should value these stablecoin issuers? Well, they'll be valued based on the growth of stablecoin, because again, you're making money for free. Right now, it's 4.33%. You're making that money for free. Someone's giving you these dollars, and you're giving them these tokens. And you're taking that money, you're buying T-bills, and you're collecting all of that interest. What's your invested capital? Only the platform. You're asset light. You're making all this money. So if you can be the dominant stablecoin, then yeah, you've got something there. Because all that money is that you're making is free. It doesn't. There's no wholesale cost of your money. It's not as if, look, I'm borrowing money at 3%, investing it at 4%, and I have net interest spread. Your spread is zero to whatever it pays. So as interest rates go down, they will become less profitable. So if you believe in inflation and you believe a company is going to be a leader in stable coins, that interest rates are going to have to go up even on money market funds, then whoa, they're going to make money. But if you think interest rates are going down and they'll eventually go to the zero line, then none of these companies are going to make any money if T-bill rates are 0.2%. Remember in 2015, 16, 17, the rate on the 3-month was, 20 basis points? So if you think that we're going back to that, then none of these companies are going to make any money on this. The administration of just complying with the reporting requirements would probably cost more than the 20 basis points, which would make these people lose money in their business. This works at high interest rates. It starts to lose its attractiveness at very low interest rates. So if the market for stablecoins is growing by 20%, but interest rates drop 20%, they go from 4.33 to 3.2, that offsets the growth, right? That offsets the growth in the float that you have. I personally think, wait till the first crisis where the Fed has to cut that rate aggressively. These companies are going to reprice very fast and very hard. Gaps down, trading limits hit. You'll have trading halts every 7 minutes on these things. They will gap down badly. That's the risk you're making. Is you are tying your fortune to a floating rate, controlled not by the market, but by a central bank, with a administration that wants to put in a Fed chair that is going to, cut aggressively, right? Okay, let's see if we can get. Been reading about stablecoins lately. Seems like the use case, it's not with the end user, but banks. Right now, with Visa, MasterCard cost 0.13, 0.15 clear credit card transactions. Yeah, it is. It's more of a supply chain issue. Think of a company. I'm just going to give you an example here. With different countries: country 1, country 2, country 3, country 4, supplier 1, supplier 2, supplier 3, supplier 4, supplier 5, and then this is the domestic country here. And you have to pay all of these people, and you have to pay them. Let's say the whole chain is on US dollars. If they're across different borders, it gets expensive to pay. And country 1, the supplier here, might have input in US dollars, and of course its output is going to be in US, so it's going to receive US dollars for its output, but it's got to pay US dollars for its inputs. So they'll have some working capital amount that they'll keep in stable coins, and when they clear, it clears instantly. It's at a much lower cost than it would through the banking system. So supplier 1 could pay supplier 2, they get it instantly, which pays supplier 3, they get it instantly, which can pay whatever suppliers it happens to have. Or when the vendor here pays, you can pay down the channel fairly quickly. So it's more for business to business, cross border. For example, I have to use US dollars and I'm in Canada. I have to use US dollars in the US because I have people I pay there, and I have to use US dollars in Costa Rica because I have people I pay there. For the US, I send money to PayPal, and then I distribute it there, but it has a cost and it has a delay. When I send money to PayPal, I have to take US dollars from my Canadian bank, send it to the Canadian US branch, which happens instantly. And then when I execute a transaction from this branch to here, it's sometimes 3 to 4 days. I know it's not 3 to 4 days. I know they get it pretty much the next day, but then they say, okay, we want to earn interest on the float for 2 to 3 days off of this guy. I know that's what's going on. So it's not like it just costs me $2 to send money. They're making money on the float. And then getting US dollars into Costa Rica, I can get it there fairly quickly, but then you have to, with anti-money laundering, you have to jump through a whole bunch of hoops to have it available for you, which could take up to a week sometimes to 2 weeks to have it available. So you got to line it up ahead of time. Well, if I had stablecoin, it would flow through fairly quickly with bypassing the banking sector. So there are lots of use cases for stablecoins. I'm negative on the whole crypto space other than stablecoin because it's far too volatile to act as a method of payment this way. But if they're all backed by US dollars, in my mind, what's the difference? What's the difference? Can you share more about Costa Rica retreat? I'm unaware about the place and what it is about. Well, you'd have to just DM me or email me directly, and I'll share some information with you about that. I never understood the one-time hit to inflation. It's just a bad assumption. No, it's not. Let's say you buy something for $100 and the country you're in has a 6% sales tax. It walks out the door at 106. Next month you buy it for $100, 6%. It walks out the door at 106. Month over month, zero. Well, they're going to raise the VAT to 9%. You pay 100, it's 9%. Now it's 109. So yeah, there's inflation. You buy it for 100, sales tax, sales tax is still 9%, 109. Look at that, 0% inflation. It's not as if you go back and it's another 3% and another 3% and another 3% on top of the 6. It doesn't compound. It only happens once. And then when you go back to buy it, it's the same price you paid last time with the extra tax on it. It's not a bad assumption. It is fact. It is reality. Companies can raise prices gradually. Some wait new inventory to come in. Some raise now, some later. It doesn't matter. I mean, it doesn't matter. Honestly, let's say that this happened over 3 months with 106, 107, 108, and then 109. Then you'd have 107, 108, 109. The cumulative impact is the same as the sum of all the little impacts. It doesn't matter. It really doesn't matter when it happens. Some have not even seen the whole effect yet. Yeah, I think we can jump past that. If Walmart raises prices this month because of tariffs and my groceries goes up this month, and then Apple's raise prices next month on a new iPhone, again, the sum of little things add up. Like if everyone did it at once, it would be the same thing as the sum of all the little things happening. Yeah. So let's. You're continuing to make the same argument. From your point of view on AI, along with domain experts, I've understood that you should be using AI or other cognitive domain emulators. There we go. Let's call them what they are: cognitive domain emulators. Once you become an expert in a particular sector or domain, as a novice or someone less than 5 years of certain industry experience or domain knowledge needs to first do the hard work to learn, understand, and aspire to become knowledgeable. Yes. And sector expert in the field. Until that, I guess it's worth do the hard work, even though you may ask AI certain tasks and explanations. Okay, so that's just a statement. It appears to still be worth learning how to use AI. Oh, it appears to be worth it. It is table stakes. In 2 years from now, if you don't know how to use this stuff, you're obsolete no matter what you know. Same time, try not to use it to first do the hard work to become first domain expert. Or you, once you are, then I think you are free to use it. Don't you agree? Such a pattern. Well, that's like saying I'm not going to use a textbook until I become a domain knowledge expert. Because if I use a textbook, I'm getting the information given to me by someone else. I'm not getting it myself. It's okay to use these tools to learn. It's not okay to get these tools just to do the work and never learn it. But if you're using them as a learning tool, well, that's perfectly fine. Sure. Let's see. That's just answering someone else. I agree with you that AI is huge deflationary. Isn't it more comprehensive to entail the initial upfront investment? What does that mean, to entail the initial investment? All these CapEx investments in data center lumps are being channeled towards AI, which may cause a potential inflationary pressure. Why? In the beginning, before opposing deflationary force picks up in magnitude. I'm not seeing that. Why would my CapEx be inflationary? Unless you think that there is so much widespread price pressure because of GPUs and data centers. But I'm not understanding how purchasing of GPUs and data centers are going to make my vehicle more expensive, my insurance more expensive, my healthcare more expensive. Healthcare companies aren't doing the CapEx. The technology companies are, out of their own cash flow. So it pushes the square footage price of data centers up. How many of you are saying, God, you can't even buy data center space now with these guys? I mean, I'm not in the market for data center space at all. I'm not in the market for GPUs at all. Everything they're buying is so far upstream in the value chain. I'm not buying any of that stuff. Consumers aren't buying GPUs, right? So it's not in the CPI. Consumers are not buying GPUs. If it's anywhere, it's going to be in business investment. So it might show up in PPI somewhere. But that's a very industry specific thing. You can have prices go up in a particular industry, in a particular part of the value chain. That's not inflation. That's just prices going up on that stuff. But it doesn't feed into the general level of prices. It's just for particular things. So for it to be inflationary, you'd have to make the case that it's going to feed into the general price level across the board. The investment part, I don't see that it's doing that. We've had these massive data centers being built out for a couple of years now, billions and billions of dollars spent, and CPI is well behaved, PPI is well behaved. It's not showing up anywhere. So I'm not, just because there's demand for a product, great for the company. Bravo for NVIDIA, huge fat margins. But that's not inflationary. That's just high prices on GPUs. It'll keep the prices high for some time, but it's not as if it's getting higher and infecting everything else. It's not as if Walmart says those carrots have to cost more because Meta's spending $60 billion on AI infrastructure. Do you get that? Like it doesn't spill over. When you suggest to listen to conference earnings calls of a company, where do we listen? A transcript or press release? They have it live on their site. They'll tell you when the conference call is, and you can click on the link and you can listen to it live. Couldn't we see stablecoin that holds a basket of short-term bonds from different countries be a way to counter the risk you talk about? No, well, the act is very clear. They must hold US dollars US T-bills with a maturity of less than 12 months or engage in repos. Backed by treasuries, not backed by... Now, you can have repos that are backed by corporate bonds. The haircut is just bigger, but that's not part of the act. So the government is designing an act such that you get multiple benefits out of it. They're not going to say, yes, let's do stable coins and you can go ahead and support Germany's bond market and give them lower yields by supporting Germany's bond market. They're not going to do that. It's no, you support the US bond market, you create lower yields for US treasuries. They're not going to create demand for any other country's bonds, and I don't blame them. Why should they? It's a US dollar stablecoin, should be backed dollar for dollar. It has its own benefits in the savings that the users are going to realize by avoiding all of the transaction fees from the bank. They're going to give up the interest on it, but the amount they save is so much more. I want you to think about this for a minute. I give $1 million and I get $1 million in stable coin. This company is going to make $43,300 off of my million. But I'm going to save 30 basis points. You think 30 basis points, that's nothing. What are you saving here? $3,000. But I'm doing this every week. The level of clearing that I have to do is $1 million a week, every week. 3,000 times 52 is way more than 43.3. Besides, if I am clearing $1 million, you know what I'm doing with that $1 million? I'm not putting it in T-bills, because I need that money to clear on a daily basis, a weekly basis. I need that in cash to clear. So it's sitting in an account somewhere. It's just sitting in a checking account, not earning anything anyways. So the savings I'm going to get, because this turns over and 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 over again, every time it turns over, 30 basis points, 30 basis points, 30 basis points. The other side's only getting 43.3. So it's costing, opportunity cost of 43.3 for me to save how much? 156,000? Clearing $1 million a day that I have to pay 30 basis points on to a credit card company, right? Think of Walmart, where it's more than $1 million a day. So the idea of holding a stable coin that doesn't pay anything, yes, it does. The amount of money that I'll save on these transaction fees. The other side, I'll gladly give them the interest rate on that. Now, as interest rates go down, they make less, but I still save all those transaction fees. It is great for me. Great for these guys, they're making that for free. So the US government says, why should we help any other market out? Let's do it ourselves. Isn't that beautiful? So no, I doubt if you'd ever see another country's bonds in there. What are your views on US dollar depreciating this year? I think it continues to depreciate. I think we're sort of underestimating the amount of negative, I wouldn't say goodwill, badwill that is building up in nations across the world. These trade shakedowns, and that's what they are. One guy walking around poking his finger in your chest saying, you're going to do this, and if you raise your hand to slap me back, I'm going to hit you even harder. This belligerence, when the U.S. hits a weak spot, and they will, they'll have no friends. It will hurt even more than it would normally hurt for whatever problem they happen to have. And if they do weaken, look for the rest of the countries to beat up on them. Look for them to gang up on them. All you need is a sign of weakness, and the herd will attack. So I think the U.S. is setting itself up right now for, if you're going to go it alone, you got to make sure that you stay healthy for 3.5 years in all respects. You stumble, you fall, you hurt yourself, it's going to get ugly. So yeah, I think the US dollar continues to weaken. I think more central banks are going to say, we don't need these US dollars. You want us, you're forcing us to trade with partners that we didn't have to before because you were there. Now we're going to trade with them. We don't need as many of your US dollars as we used to because on a trade weighted basis, your currency's not that important to us anymore. That will force a rebalancing of reserves across central banks. Maybe not an outright selling of treasuries, but certainly the demand for treasuries dropping at the central bank level. We're seeing that with gold. Some central banks are now holding silver. So yeah, I think it continues to weaken. And honestly, I would seem to think that would be a benefit for the US is to have a weakening dollar. If you had a weakening dollar, you could fix your trade balance without the need for tariffs, but you do have debt to pay, which means you got to tax your citizens somehow. Tariffs are a great way to tax them and lie to them at the same time. Did you hear the announcement today from Trump about the Philippines? The Philippines, they charge us nothing, and we charge them 19%. Because that's the tariff. We charge them 19% and they'll charge us nothing. That is not the right way to say it. That's the way to say it when you want your citizens to think that it doesn't cost us anything. Let's say it the right way. The Philippines is going to charge its citizens nothing if they buy a US product. But the US is going to charge its citizens 19% if it wants to buy a Philippine product. So if you're ordering stuff from the Philippines, sorry, you're going to pay an extra 19%. But the Philippine citizens, they don't have to pay anything. That's the right way to say it. We're going to charge our people 19%, and the Philippines will charge their people nothing. Nothing. When you say it that way, right? It is a tax, and it's Americans who pay the tax. You could say, well, no, the exporting country is going to lower their price a little bit. Listen, if the exporting country is going to lower their price because of tariffs, that means they could have lowered their price anyways, right? They're not going to take a loss. If there was room in their margins to lower their price, the supply chain is so efficient that would have been squeezed out anyways, because the exporting country, the Philippines in this case, are going to find a way to cut costs out of the system. Well, suppliers have been squeezing, buyers in the US, companies have been squeezing their suppliers for hundreds of years. That's the way it works. You need to get some costs out of those costs. If there was room to cut because of the tariffs, there was room to cut that would have been cut anyways. So all you're doing is just accelerating that process and bringing those cuts forward. So if we say it the right way, you still need that. You still need to tax your own citizens. I forget what point I was making now. Anyways, okay. US dollar I think continues to drop. Whatever point I was making, I've lost it. Please explain why imposing a tariff reduces aggregate demand when government may spend that tariff money. Are they? Are they spending that tariff money? If they're running a deficit, they're not really. They're still. Well, how can I say this in a way that makes a lot of sense? A tax is just a money transfer, right? It is a transfer from the household to the government. So the government puts out a budget and says our deficit this year is going to be 1.9 trillion. That is what the government is forecasting. This is not the CBO. This is not scoring by the CBO that says, well, we're not going to pay attention to tariffs. This is the government putting something out. Tariffs are in here, right? Tariffs are in here. If you didn't have tariffs, they might have spent 2.2 trillion. Or the deficit might have been 2.2 trillion. And if they're going to raise 300 billion, then it's only 1.9. They would have spent it anyways. So it's not as if it's extra money to spend. They would have spent it anyways. It just makes the deficit less. At least you hope it makes the deficit less. But it usually has been the experience that if a government raises more money with taxes so that doesn't have to deficit spend. It really only gives them permission to even spend more. So, yeah, looking at that, you might have a point that the extra revenue just might embolden them to actually just spend more. They could do that, sure. But there is a difference between consumer spending and government spending. Government spending is very inefficient. Consumer spending always has the higher multiplier. Government spending has a very low multiplier. So a dollar spent by a consumer through the multiplier effect adds more to GDP than a dollar spent by a government. Should there be a rate cut in July? Yes. Let's click on that. Yes. Vote. 60% are saying that. Look at that. Yes, there should be a rate cut in July. There should have already been a rate cut. The Fed had permission to cut. They do have clear permission to cut, and a whole bunch of resistance building up now to them not cutting. They have clear permission. Now, Trump should have just kept his mouth shut, would have a rate cut. He's made it political, so now, if they do cut, what's going to be the market reaction? So Powell's going to have to come out and say, look, here's what we arrived at. And because it's going to look suspicious, there's a high probability it's going to be a September cut and not a July cut. But now that is political. So he can't help but be political at this point, not because he's political, but because he's been in a position where now it's a political decision, which is, let's make a decision. You want to make a situation worse, get the Trump administration in on it. Do you think Sharpe ratio is a good metric for traders' performance? Only if the returns in your portfolio are normally distributed. If not, then no. What is your Sharpe ratio, if you don't mind me asking? It's a ridiculous number. It's like 7 or 8. It's a ridiculous number because I use options. So I have a non-normal distribution of returns, a very non-normal distribution. So the standard deviation, the assumption here is that returns are distributed normally. If they're not, then it's just, you're just making up a number. It's the wrong denominator. So no, it doesn't work. Still investing in Intel? No, I'm out of Intel. What did I do today that was it? GM. I sold $50 puts on GM. I saw GM's drop, the 50 puts. I sold that. They're still forecasting about $10. So they're trading at 5 times forward earnings. 5 times forward earnings with a proven ability and willingness to buy back their own stock. I will sell puts on GM, absolutely. This pullback to me is a bit of a gift. So, and I don't expect the tariffs to really last that long. On Sunday's market outlook, by the way, somebody on Discord pointed it out to me. Was it on Discord or was it on YouTube? I think it was a YouTube comment. Pointed out to me July 31st is the court hearing on the legality of Trump using the sections in the acts that he's using. National security, that kind of thing. There's the court case is that date, and the decision would be expected by, I think it said, when I asked Perplexity, about August 15th. This all could be declared illegal and an administrative or an executive overreach, and that only Congress had the power to do that. So this could all go away in a couple of weeks, and then everybody who paid the tariff would have to get a refund. Now, of course, they'd file an appeal and they'd keep it in court for as long as they can, and then he'd bully Congress to pass a tariff act, whatever the case is. But this could all just go away in a little bit of time. Could all go away. It could all go away. We'll see if the judges, what the judges say. It is an overreach. It does belong to Congress. However, it's Trump. And you do not want that guy in your life one single bit. So lots of people just say, look, keep your mouth shut. Don't say anything because we don't want him in our life. So these judges might say, do I really want this guy anywhere near my life? Do I? Let me just side with the administration. I'm not going to die on this particular hill because that's what he's like. That is what he's like. So who knows what's going to happen? But I didn't think of that. July 31st. Wouldn't you agree that the finance or investment industry is very unsimilar to other sectors or industries in a sense that as a finance professional you will learn about different sectors? Yeah. Industry segments of the specific sectors become aware of intricacies, key economic or sector dynamics, eventually equipped with specific domain knowledge. Why is that unsimilar to other sectors? I don't get that. Why is finance unsimilar to other sectors? That is the job of finance. I mean, you could say the same thing of every sector. You know, isn't healthcare unsimilar to every sector? Because you got to really know a lot about health and biology and chemistry. The other sectors don't. Yeah, but that's the point. That's why it's called a sector. So I'm not sure why we'd say that it's so dissimilar. All the you can say that for every single sector, right? Mining sector, you got to know a lot about geology. That's not true of any other sector. So I'm not sure that I'm seeing such kind of pattern in other industries or sectors like medicine or technology or media or even mining, trade or transportation, where you will very likely be limited to domain knowledge within specific sector. But that's the job. Who says somebody in technology doesn't understand finance? You have CFOs in every healthcare company managing their corporate treasury, buying swaps. You have marketing people in every sector in every company. I'm not getting why that's any different. The raw material for finance is analysis, economic and financial analysis. That's the raw material. That's what you're expected to know. You're not expected to know biology, so yeah, I'm not quite getting that. Sorry about all the things going off here. These Apple devices. I bought a new iPad online today. I bought it has the M3 in it. And Canadian price is $2,100 for an iPad. Apple. I think you're going too far. I mean, I'll pay for it, but this is starting to get ridiculous. The new M5 is expected out this fall, but I got two iPads. One needs to be replaced. I'll buy an M3 now. I'll buy an M5 in the fall. That'll probably be $18,000 for an M5. I think they're at the point where any more price increases, I mean, you're really testing the loyalty with these prices, really testing the loyalty of your customer base. You go any further without any AI adoption into these devices in a year from now, I'm not buying this stuff. I'll buy something else. So anybody out there from Apple that's listening, and I know Tim Cook listens religiously. So let's see. Literally, good news is excellent news, and bad news is for equities. It seems that way. Seeing my portfolio hit all-time highs every day. Same here. Now I'm getting anxious. How to deal with this type of anxious situation? Well, I guess I can't answer that. It really depends on what you're holding. If you're holding particular names that are tied to all of these high-profile stocks and meme stocks, yeah, you should be anxious on a daily basis because that could go away overnight with one bad event in the world. Always remember this: equities don't need a reason to go up; they need a reason to go down. This is true. That reason is usually hard data. Not behaving well. This is true. I've said this before. Equities will price in good news 100 miles away. If there is a whisper of a wisp of good news on the horizon, equities will price it in. But if there's fire on the horizon, If there's fire across the street, If your front lawn's on fire, Not until the curtains are on fire do Americans leave the house. In the US market, bad news actually has to show up, but good news can always stay on the horizon. There can always just be the promise of this good news coming tomorrow, 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 tomorrow. And it never has to come. It just has to have the promise of coming. But bad news, impending bad news, there's going to be a massive earthquake in 2 weeks. Yeah, but that's 2 weeks away. Next week, but that's a week away. It's going to happen tomorrow. That's tomorrow. It actually has to happen. That's the tough thing about being short. When you're short, you got to be tactical, because it's not enough for the risk to be elevated. It must actually show up. So yeah, I agree with this post. Any update on expected sector specialist designation? As soon as I have all of the PDFs for the applied level, and there are 4 of them done now. If you go into consumer staples, consumer discretionary, materials, and utilities, the PDF for all of these are up. To have a good sector specialist designation, you have to have all 11, and then you have to have at least 2 of the sub-industries in each one. And I've done 15, I think 15 to 16, because, well, you've seen the videos for them, understanding copper mining, gold mining, utilities, that kind of stuff. So I have 15 to 16. With 11 sectors times 2, you need 22. I've got all the sectors done. I just have to turn the videos into transcripts, turn the transcripts into notes. So that's all done. I got about 15 or 16, so I'm almost there. Then you need a QBank. And that is what I'm building right now. So yeah, I'm working my way back to you. I'm working my way to getting it done. Sorry, every time I hear the terms "working my way," I keep thinking of that. I'm working my way back to you, babe, with a burning love. I should have been a singer. Would you be interested in hiring an apprentice or intern, at least for your applied level content? Don't really need it. With AI now, AI does incredible for me. Let me just explain my question bank, just so that you have an understanding. I've shown you the question bank. AI writes that for me, which is mostly true. So what I do is I think about the question, and I think about the premises that I need. Bullet point. I can come up with that very quickly. And then for the multiple choice options, A, B, and C, I can come up with a couple of bullet points for each, and then my conclusion, whatever answer it is, bullet point. I can do this in about 6 to 10 minutes. But what takes time is you take your premises, you say, okay, Arnold so-and-so of so-and-so a company is looking at this. This is what he's doing. Writing that paragraph, and then writing out all of the answer choice, and then writing out the long explanation. That's the tedious part. That takes a long time. This is 6 to 10 minutes. This is 30 minutes to get this done, to get all of that writing done. And you got to type it in. You got to put it in Word. You got to make sentences. You got to make paragraphs, because you have to get it into the question bank, and you got to cut and paste. So now I'm down to this. I do my bullet points. I do my premises. I do these all in bullet points. I give it to the AI, of which I have given it detailed instructions on exactly how to do this, and it writes the scenarios for me. So I can now almost triple my output. If it would before take me 30 minutes plus 6 to 10 minutes, let's say I could get 2 done per hour doing it myself. If I'm doing 6 to 10 minutes and now giving it to the AI, let's say it's taking me 10 minutes, I can now do 6 an hour. That is an increase of 3 times. And where you burn out cognitively is not here. This is fun. Actually coming up with the scenarios and bullet points, that's fun to think of a scenario. Well, let's do this, let's have this, let's have this. That's actually very fun. What's tedious is the typing of it all out and writing sentences. When you know what the outcome is going to be, you already have it, but you got to go through that process. That's where you burn out, is in the 30 minutes down here, not up here. So my productivity is much higher than just 3 times because I can do this all day long because these are fun. This is the tedious part. So I make all my bullet points, I give it to AI, and question. Then I just read, okay, let's change these words, good enough, go. Let's read, okay, that's good. Let's read, okay, that's good. Oh, you messed up here, do it again. Okay, good. Let's change this word over here, good, go. That's it. That's all I do now. I write in bullet points, I give it to the AI, and it writes like me because I gave it, I've written thousands of questions for CFA. So I put it in a document and I give it to the model and I say, this is how I write. Here's the bullet points. Write questions the way I write. And I'll be honest with you, when I read the questions it writes and I read what it wrote, I think that's better than what I could have written. It writes better than me. But if you don't give it the bullet points, if you don't give it the premises, it sucks. There's a nuance to doing this. It'll write very obvious questions, and when you get it to write questions, here's what you get out of it: is you'll get a scenario. There's your scenario, and it'll say A, B, C, and A will be do this, B will be do that, C will say take a middle road, and it's always the middle road. It's always the middle road. You don't even have to read the setup or what. You just have to say A is saying you should go all the way this way. B is saying you should go all the way that way. C is saying, well, you know, it's a little bit of this, a little bit of that. And it's like, oh, you're missing the point. Like, it shouldn't be this all, but no matter how much you push it, its answer choices always end that way. So what you do is you write your premises and you say, A must be centered around this bullet point and this bullet point. B must be centered around here. C must be centered around here, such that when you read them, you go, oh, hang on a second now, because these have trade-offs. And now it becomes much more difficult. But it can't write at a metacognitive level, but it can write if you give it the metacognitive bullet points. So I don't really need anybody right now because I find that my output has dramatically increased. And here's the problem I have. I have somebody inputting this into the system. I can deliver content to them faster than they can get it into the system. I am no longer the bottleneck. Getting it into the system has now become the bottleneck. So I have one person full time. I have 2 people coming tomorrow. And hopefully I can, either one or both of them, I can get doing the same thing. Because I can generate at the speed of which I could have 3 inputting. That's where I am right now with the help of AI. By just bullet point, here, write my scenario. And it writes, like Gemini writes better than me. Claude is not bad. But you have to reverse engineer Claude. You can't, with Gemini, you could tell it what you want and it gives it to you. And then you could just change your prompt. With Claude, it doesn't work that way. You must first figure out how it sees it and then get it to write the prompt that it sees, and then it can get okay. But you can only give Claude 1 or 2 at a time. Gemini, I can give 5 at a time. I can say question 1, bullet points, question 2, bullet points, I can give it 5 and it can give me 5. At 10, it starts to suck because it doesn't see it as one thing 10 times. It sees it as one task of 10, and it's too many parameters and it breaks down. Gemini can do 5. Claude, I can get it to do 1 or 2 at a time. And Claude, a couple of times I've hit the limit where it says you've hit your limit for the day. It'll reset at 9 p.m., which is 9 p.m. Pacific time, which is midnight. It's like it wants you to upgrade to the $140 a month model. But Gemini, I've not hit any limits on that as of yet. Dollar for dollar, Gemini is by far the best I've worked with. And I push all of these models. I've given up on Grok 100%. Grok sucks. It's so bad. It is so bad. And OpenAI, I don't get the fuss. I don't get the fuss. I think OpenAI had a first mover advantage, and I think people who stay with AI saying this is great is because they've never tried Gemini. Try Gemini and work with that for 3-4 weeks and go back to AI, and you'll be saying, what was I so impressed about? I don't understand why everyone is so enthralled about OpenAI. Google, by far, has the better model. Looks like DXY is stubborn and still bearish. Do you think with recent data and tariffs, dollar could go to 90? Well, that is the thinking from a lot of places, especially some of the banks in Canada are thinking that as well. Now, when they start thinking that, and that's what they're thinking, they start positioning for that, thereby moving the currency towards that point because they are actually shifting. Reducing their exposure to US dollars, increasing their exposure to Canadian dollars, which then pushes the Canadian up and the US down. And if more countries feel the US dollar is going to drop in value, more portfolio rebalancing will be done to underweight the US, especially in areas like utilities or staples, because there's not the big capital gain that could overwhelm the depreciation of the currency. Technology and healthcare maybe, but you'll still have a rebalancing away from the US towards other currencies, which will accelerate that. So yeah, I'm sort of on board with that. And I think this is the last question here. Let's see. Yep. Do you think leading up to the midterms, Trump will be more aggressive in implementing policy, and specifically policy beneficial to his family? Oh, he's up what? What was the last number we heard? $8 to $10 billion. I think it was Barron's or Wall Street Journal that reported this. He's up. His wealth is up some $8 to $10 billion since he took office. 6 months. He's never made more money in any other venture than president. And he will leave office. Mark my words on this. He will leave office as the single richest man in the world. He won't stop. This is self-enrichment out in the open with no embarrassment. He will continue on to the point where other dictators around the world will blush and say, holy shit, have you seen what this guy's doing? Like right out in the open. He will make other dictators blush with the extent to which he will self-enrich. Oh, I've said that months ago. I said that a year ago. That he will use the office to massively self-enrich, and he is. He absolutely is. I get these emails from Truth Social every couple of days because I have an account on Truth Social because that's how I was following his truths. We're launching this, we're launching that, we're launching this. Not stopping. He is going to grift as much as he can. He wants to start a streaming service. So what's he doing? He's shutting down. Look what he did with late night, right? He's trying to shut down as much as he possibly can. There was some report about a limitation in the Genius Act that nobody in government could be an issuer of a stablecoin, not even the president. He wouldn't agree to that. He said, no, take it out. The president should be allowed to do it. Take it out. Why? Because he's probably going to do it, and he's probably going to grift on that thing too. Yeah. I don't think he really cares. I think all of this is a sideshow for his real purpose, which is to make a shitload of money. And this is just the way it's done. Be the president and just make a shitload of money. And okay, I guess I got to do presidential things every now and then, but yeah, I'm not really into it. Regarding this, the S-curve for AI, what type of metrics would you point to that would reflect a short-term top in the curve? Well, it would be a decrease. As right now, I don't know if you use OpenAI, ChatGPT, you'll notice if you are using it often enough, you'll notice now it's saying, which do you prefer? We're testing a new model, and it'll give you a side-by-side of which you prefer, and you read your answer here, you read your answer here, and you click on which one you prefer. It gives you both answers because at the end it has this thing like this, and it says a 2 of 2, and then you just have to click backwards, you'll get this answer. If you say I like this one, this is the one it prints, but then it'll have 2 of 2. You can go back and forth between the two. but it's testing a new one. And I'll tell you, as I read them both, I think, you know, it's not as if one is so much better than the other. It's like, I guess I like this one, you know, but it's about the same. Just you're saying it in a different way, but it's about the same. So I think ChatGPT 5 might not come out this summer, maybe this fall. I think they're going to see on the feedback that it's not enough of a step increase in performance. Unfortunately, we're at the point now where every new model is not going to be that much of a step up in performance. It'll become really killer at declarative knowledge, but the internet was full of declarative knowledge. It'll become really killer at conceptual and be really good at procedural, but still won't hit the metacognitive level. It still can't get there. And I think that is where this current type of technology, these big models, will plateau out. Now that's the limit of the model. But think of everything you can build upon that. This model itself, the real excitement on this is not only is it an amazing search engine, not only can you build amazing browsers with this as the background, this is what it's searching, is the model, not some list of URLs and then reading the URLs to come up with something, but it's reading this. It is as an operating system that it really starts to get exciting. And you could see this being embedded in products that then become really exciting. So there's a long tail to this. There'll be incremental innovation on this for years until you come up with a better model. It took, 24 years to displace Google? Google search, by the way, URL search, that's dead. That's dead. Give it another year, it might make up 20% of search. That is dead. Once you start using Perplexity, you can't go back to a URL search because you get these URLs, you go, well, which one do I click on? Now I got to go hunting for all of this myself? Yeah, you get the little AI stuff at the top, but it's what you get used to. Google is being rather late on this, but now I'm hooked on Perplexity. That's all I use when I want to search for something. Is I type in a sentence. Yeah, I talk to it like normal language. Blah 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 blah. I can even hit the microphone and just say, "Look, this is what I'm looking for." The recognition of the speech is spot on, and I get my answer without having to click on this URL. Going, nope, this sucks. Nope, this sucks, and then it gives me all the sources, so I can look at the sources, and it picks good sources. So I can go to any of the sources. It's just so much better. You know what I'm saying. But I think search is probably going to be dead. So even though you do have an S curve on LLM, LRM architecture, the long tail of all the innovations that can come off this, right? You have your first layer, which is your architectural layer. Here's your GPUs, whatever you're building your model on. Here are your foundational models, right? You got Gemini, you got ChatGPT. On top of that, you have all of your applications, right? And then you'll have applications that go the other way. On top of that, you'll have a hardware layer of consumer devices, right? So this is the full stack. We're somewhere in here and really starting to come here with the whole idea of AI agents. And these AI agents will eventually be embedded into devices. We haven't even hit this layer yet. We got a long tail on this. So the technology behind the model has an S curve. But that does not mean that we would expect to see that this will hit some kind of plateau and then everything will crash. There is a long tail of innovation that can be built off of this. 10 years, 15 years. I'd probably say you're looking at 15 to 20 years before you have another really big breakthrough. AGI, this general intelligence, that's a fantasy. That is a fantasy because you have to not only have this idea that I built a complicated system. These are complicated systems, these models. And a complicated system sometimes has unpredictable output. That does not mean you have an emergent property. It just means it's complicated and you have an unpredictable output. You have to go from complicated to complex to be able to hit emergent properties. I don't see that really happening with whether you're using TPUs or GPUs or CPUs. I don't see that happening. Maybe quantum computing can create states where suddenly you can use a different model that does something more, that does create an emergent property, but it would still be code based. Well, I guess with quantum computing, you can also get it state based too, not just code based, but state based. And there, who knows what you're going to get, because that's not well understood yet either. Call it 20 years before you get another S curve. Lastly, the no tax on capital gains that has been proposed seems very bullish for the housing sector. Yeah, it is. It is being thought about. Have you been looking at the builders, or do you still see the mortgage rate as the number one driver? Builders had a wonderful day today. Lennar, what was that? Up $20? No, DR Horton was up big. Pulte was up big. Lennar was up. The whole sector was up big because they're killing it now. So what are they going to do when rates drop? How much are they going to kill it when rates drop? Right? So, anyways, that brings us to the end of today.